Financing your first single family rental. What's up, everybody? It's Jeff Javarthan, Jeff the Mortgage Pro. Thanks so much for watching. Let's talk today about financing your first single family rental property. So there's two ways to do it. One of the loans that you may have heard kind of as a buzzword out there is called a DSCR loan. It stands for Debt Service Coverage Ratio loan. And this is a good product. I'm doing a lot of these types of loans across the country. What I would say though is that they're for more sophisticated type investors, people who kind of know what they're doing already when they're buying investment properties. So probably stay away from those. Usually what you're going to do when you buy your first investment property is you're going to use a conforming loan. That's the simplest way to go about doing it. That's the loans that we use traditionally for just about any other investment property that you're going to buy with the traditional methods across the country. Okay. So let's go over some of the details of a conforming loan and what that looks like when you're buying your first investment property, when you're going to finance it. You're going to need anywhere from 15 to 25% down, and even more than that if you have more money. But you want to make sure that the property is going to cash flow nonetheless between 15 and 25% down. So one of the things to consider though is if you're going to put 15% down all the way up to 19.9999% down, you're going to have mortgage insurance on there, just like any other conventional loan with less than 20% down. So consider that when you're going to buy your investment property. More down typically means better terms going forward. So the better the interest rate or better the pricing is going to be on that particular loan. So you can still buy properties with 15% down, but just understand it's going to be expensive. Okay. You're going to need a minimum of a 620 credit score. That's pretty darn low. If you have better credit, usually 760 or better, you're going to have the best or most favorable terms when you're buying investment property. If you have a 620 credit score, it's going to be like 6 or 8 points or 10 points. It's going to be way more expensive than you probably want to pay for a property. So credit is definitely important when you're buying your first investment property, especially if you are limited by your down payment and limited by your credit score. You want to have a debt to income ratio of under 45%. One of the great things about buying investment property with a conforming loan is that we can use the potential rental income of the property or the actual rental income of the property to help us offset the mortgage payment on this new loan going forward. So that is something that will help us stay under that 45% debt ratio, but you definitely need your own other income coming in from whatever source that might be to keep that debt ratio under 45%. You need to make sure that, again, we can use the rental income coming in from the property itself to help offset the debt. There's one exception to this, and that's that first-time home buyers and borrowers who don't own their own primary residence cannot use the potential rental income of the property to offset the debt. So if you're a first-time home buyer, meaning you don't have your own primary residence, you've never bought a property before in the last 3 years, and you're buying a rental property to start off with, you cannot use the rental income to help you offset the debt. And if you are also, if you don't own a primary residence, maybe you own another investment property, you cannot use rental income to help you offset the debt. So keep that into consideration when you're going to buy your first single family rental property. So an appraisal is going to be required. They're going to help us do two things. They're going to help us determine the value of the property, just like any other type of loan that we're going to do with financing attached to it. We're going to want to have an appraisal associated with it that helps us determine what the value of the property is. And the second thing that's going to do is help us determine what the actual rent of the property is, or like the market rent would be on the property, because they're going to do a rental survey. That means they're going to take rents in the area, and they're going to figure out, somewhere around what the median rent is, and that's going to be what the rent is that we'll be able to use going forward to help us offset that debt, if we can use that number to offset the debt going forward. And then if you have plenty of money down, like let's say you're putting 50% down, there's a chance you could get a property inspection waiver. That means that we don't have to do an appraisal because it would be okay with the value. So there's a chance that you may not have to do an appraisal on a property, even though it's an investment property going forward with a Fannie Mae or Freddie Mac conforming investment property loan. Some of the investors, actually most of the investors, especially Fannie Mae, like to have you have money left over when you're done, and it's called reserves. So 1 month of reserves is your principal, interest, taxes, insurance, and mortgage insurance. If you have less than 20% down, is 1 month of reserves, and we want typically at least 6. So that can be anything like extra cash that you have lying around in your savings or checking accounts. It could be stocks, bonds, IRAs, 401ks. All those different things can be considered reserves. Some of those things like retirement accounts will take a portion of that for the reserves calculation, but we want to make sure that we have at least 6 months worth of reserves when we're buying our first investment property. You can remember that you can get a seller credit to help you offset some of the closing costs when you're buying these investment properties. You can get up to a 2% seller credit. You can't use any more than that when you're buying an investment property and you're using a Fannie Mae or Freddie Mac conventional loan to buy those things. Remember, when you are buying your primary residence, that you're going to have the most favorable terms going forward. You're going to live in the property, you have enough income, assets, credit, liabilities. But when you're buying an investment property, know going in that the cost is going to be more than what the primary mortgage rates are going to be. In fact, the cost is probably at least 1% more than whatever the market is for the current primary mortgage interest rates. It's going to be 1% more than that. So know that going in, that's always going to be more expensive going forward. I mean, it could be pushing upwards of 10% here pretty soon before we know it. That's expensive. It really is. But at the same time, so are primary, first mortgages. Primary residence first mortgages are also pushing up as well. So just be aware of that going forward. And then the same thing with paying points and the extra cost that's going to be associated with it. You're probably going to pay points when you buy an investment property, anywhere from 2 to 4 or 5 points, depending on the different factors and how you qualify for that loan. If it's a really small loan, you're going to be paying a lot of points. If it's a bigger loan, you may be paying less points. But if your credit is really low, you're going to be paying a lot of points. If your credit is really good, you're still going to be paying a couple points. Just know that points are part of the deal when you're buying investment properties going forward. So when you see your mortgage loan officer quoting you points, it's not because they want to, it's because that's the only thing that's priced out when they are able to offer those types of loans for you. Okay. And then lastly, those are the qualifications you need. But remember that at the end of the day, it's up to you to figure out if this is a good property that's going to cash flow. Remember, you are buying a business. You're buying something that's going to give you passive income. Somebody else is going to be paying your mortgage payment going forward. Hopefully there's enough money left over when they're done making that mortgage payment that you're going to have positive cash flow. That's the ultimate goal, is to have enough positive cash flow, passive income coming in, so that you don't have to make any payments on that thing going forward. Now, ultimately, there's going to be some, bumps and bruises along the way. You're going to have to make some repairs. You're going to have to, move tenants in and out. And, if you take all that into consideration, this is still a really good opportunity for you to buy investment properties, especially this time of the year in 2023. As the market pushes up, there's a lot of properties that are still available in many markets across the country. If you are one of those people that want to buy your first single family investment property, make sure you reach out to me at Jeff the Mortgage Pro. I will put my Calendly link down below, and you can click on that, schedule an appointment with me. I'd love to chat with you for 15 or 20 minutes about you buying your next single family investment property with traditional financing, and we will go from there. Have a great one. Talk to you soon, guys. Have a good one. Bye.